All right, my clock shows just after 10 o'clock, so I think we can get started here. Good morning, everyone. It's time for another webinar. Carrie's going to cover not-for-profit financial statements today. But before we get started, I want to take a moment to introduce our not-for-profit team here at DWD. My name is Tyson Moore. I'm accounting supervisor in the not-for-profit division. With us today is Director Susan Berghoff, along with our presenter, Carrie Minnig. Now, before I get started, I have a couple of housekeeping items to cover. For those who have questions during today's webinar, use the Zoom's question and answer feature at the bottom. You should see it in the toolbar right there at the bottom of your screen. We will be answering questions like we normally do periodically throughout the presentation. Also, Carrie's slides, they'll be emailed to everyone attending the webinar today, along with being posted to our website after the webinar is finished. With that being said, I'll turn the floor over to Carrie to start our presentation.
Thanks, Tyson. Thank you for all of you being here today. We are going to talk about financial statements. Before we get started, I just, whenever I talk about nonprofit financials, I want to throw this out there. Nonprofit is a term that gets thrown around, and sometimes the word nonprofit, people sometimes think that that means that the organization cannot or should not make a profit, and that is just not true. So as we go through and we think about our financials and our income and expenses, we need to remember that as a nonprofit organization, we are a business. In order to be sustainable, we have to bring in more revenue than we spend. So just because we use the terminology nonprofit or not-for-profit, it does not mean that we cannot or should not make a profit. It just means that the profits go back into the organization as opposed to a for-profit where the profits are paid out to the owner. So just want to keep that in mind. So as we look at our financial statements, obviously there's a lot of different eyes that are going to be looking at your statements. In everyday use, your executive director, CEO is going to look at your financial statements to use in managing the operations. Your board of directors is going to be reviewing your financial statements, hopefully monthly, or if not monthly, at least bi-monthly, to make decisions on the best interests of the organization. Donors and funders are going to require you sometimes to provide financial statements in order to get those grants. Reporting agencies, if you spend more than $750,000 in government federal funds during the year, you have to have a special audit done, a single audit, and also you have to submit your financial statements with that. If you have a loan, your banker might ask you to have a copy of the financial statements. If you have an audit done at the end of the year, your external auditors are going to ask you for a copy of your internal financials, and even the IRS. And, you don't actually submit a copy of your financial statements to the IRS, but the information on your financial statement is reported on Form 990. So the IRS does look at your financials in that manner. Another way that people look at your financial statements is just through your website. So does your organization post your financial statements on your website? You don't have to. There's no requirement that you have to, but some organizations do like to do that so that they can feel more transparent and put those financial statements out there. And if you're doing that, then obviously anyone, anywhere can access your financial statements. So that's really why it's important to make sure that the items reported on your financial statements are correct and properly reflect the transactions of your organization. Before we get into talking about financial statements, I just want to talk about a few basics. Some organizations follow cash basis accounting while others follow the accrual basis. Cash basis is very simple, just like your checking account at home. You put deposits in, that's when you record your revenue. When you make a payment out, that's when you record your expenses. The accrual basis is a little bit more complicated. Revenues are recorded and expenses are recognized when incurred. So they're not going to necessarily match up when cash payments are made or received. And then there's also a third basis of accounting, the modified cash basis, which is kind of a combination of both the cash basis and the accrual basis. It starts with the cash basis and then it has different accrual modifications, most commonly recognizing fixed assets and related depreciation, fair value of investments, and payroll liabilities. So when you're looking at a set of nonprofit financial statements, it's important to understand what basis of accounting the organization follows, because that is going to determine what items are recorded on the financial statements. Now, some organizations for internal purposes may follow one basis, but then when they have their audit at the end of the year or review at the end of the year, they may switch to a full accrual basis. That's fine. Just make sure that anyone looking at those internal financial statements, your board of directors, management, understand what basis those internal financial statements are on, whether it be on the cash basis plus fixed assets, or maybe it's supposed to be on the accrual basis, but we don't record prepaid until year end. So it's fine to have those internal basis or internal financial statements on kind of a mixed basis, as long as everyone clearly understands what is and is not included in those financial statements. So when we're looking at the different bases of accounting, there are certain times when it's okay to use the cash basis versus the accrual basis, where other instances, the accrual basis should probably better serve the organization. So for example, if you're a small organization, you have very simple operations, you only have one major activity, you don't really have a lot of external reporting to third parties, your cash basis financial statements is probably fine. You know, just recording receipts when you, deposits when you receive them as revenue, payments as expenses when paid, that's fine. Now, if your organization does maybe has a lot of fixed assets, maybe needs to report some to outside donors or outside reporting agencies, but not a significant amount, you might want to consider using the modified cash basis. This will allow you to record all of those fixed assets on your books. I mean, that's a big asset for the organization. And if you're not recording that, you're really missing out. But again, it's still on the simpler side of accounting, so don't really want to have a lot of complex transactions going on if you follow the modified cash basis. On this screen, it kind of tells you the difference between the three versions of accounting, basis of accounting. And as you can see, the cash basis, the simplest form, all we have is the cash balance, receipts, and disbursements. Then we move to the right with modified cash basis. As you can see, we're adding investments, we're adding property, debt, those types of things. So if your organization has a large amount of fixed assets or has a large amount of investments, you probably want to be at least on the modified cash basis so that you can show these assets on your balance sheet, because those are, again, very important assets of the organization to show. And then as we move to the accrual basis, you can see we even have more types of accounts: receivables, promises to give, prepaid, accounts payable. And that's really sometimes required for certain organizations, whether they are connected with a national organization that requires them to be on the accrual basis, or maybe they're required to submit accrual basis financial statements for grants or for an external reporting agency. So this slide here kind of gives you an idea of the difference that you will see in each of those different bases of accounting. And the next slide even goes into more detail, kind of gives you an example. Now, this is only the statement of financial position, your balance sheet. It doesn't show any income or expenses. But as you can see, the first column here is on the cash basis. So if this organization followed the cash basis, all we would show is cash. That's it. But if we decided to follow the modified cash basis and we have beneficial interest, so that's, you know, your investment in the community foundation, and we have some fixed assets, maybe we have a line of credit and a note payable, you can see that there's more items added to the statement of financial position, and it really gives a better picture of the organization. And if this organization were on the accrual basis, you can see, again, the difference of what that statement of financial position would look like compared to either the modified cash basis or the cash basis. So again, when you're looking at a set of financial statements, you want to make sure you understand what basis of accounting the statements are on, because as you can see, there are going to be certain things that aren't recorded if they're following the cash basis or the modified cash basis. Also, some basics, we're gonna look at a set of external audited statements today. They will probably look a little different than your internal statements, but that's okay. The concepts are gonna be the same, the accounts are gonna be similar. Other differences, sometimes internal financial statements may lack some GAAP elements. Again, we talked about, they might be presented on the cash basis as opposed to your year-end audit being on the accrual basis. That's fine. Again, as long as everyone who's looking at those internal reports understands what is and is not recorded, that's okay if there's a difference between your internal and external financial statements. There's also going to be some differences if you are used to looking at for-profit statements. So we use some different terminology in the nonprofit world. We use net assets instead of retained earnings. We use increase and decrease in net assets as opposed to net income or net loss. And then we also have additional terminology that is not used in the for-profit world, such as contributions, promises to give, donor restrictions, or designations and functional expenses. And we'll get into these, what each of those represent and what you should be looking for when you have these types of accounts as we go through the actual statements. But I just did want to point out that if you are used to looking at for-profit statements, you will notice some differences when you're looking at nonprofit statements, as well as the title of the statements. So in the nonprofit world, the balance sheet is called the statement of financial position. The income statement is called the statement of activities. Now, because we don't have any owners in a nonprofit organization, we do not have a statement of stockholders' equity. However, we do have a statement of functional expenses, which the for-profit statements do not have. And then we both have a statement of cash flows. All right, so let's get into the actual statement. So this is the statement of financial position, or the balance sheet. So when we're looking at this statement, we want to remember that it is going to be as of a specific date in time. There are some requirements that you can see that have to be on the statement of financial position. And most important, your assets have to equal your liabilities plus net assets. So on the screen, this again is a sample statement of financial position. This is an external audited statement. However, if you're following along with your own statements, even if you have your internal statements, the accounts, I'm sure on the left, are probably going to be very similar to what is listed on your internal statement. So what we talk about is going to be applicable whether we're looking at an external audited statement or internal statement. So we said it's going to be as of a specific date and time. So when you're looking at the statement of financial position, you need to know what date you're looking at. So this one is as of December 31st, 2022 and 2021. So this is at the end of the organization's fiscal year. If you are looking at internal statements, these are probably going to be at month end. So January 31st, February 28th, and so on. So that just gives you an idea. So as of this date and time, as of December 31st, 2022, these are the accounts and balances that the organization had on their books. Again, most important, we have to make sure that the assets for 2022 equal the liabilities plus net assets for 2022, and same with 2021. If these numbers do not match, it's done incorrectly. You have an issue. Your financial statements are wrong. So that's the first thing to look at. Make sure that your total assets equals liabilities plus net assets. As we look to see what is actually on the statement, normally we list the accounts on the left, or type of accounts, by liquidity. So those that are like cash is usually listed first. And then after that, it is how fast they can be converted to cash. So accounts receivable, contributions receivable usually come next, and so forth. Cash, accounts receivable, contributions receivable, prepaid expenses on this statement are considered current assets. That means they are usually going to be converted to cash within a shorter time frame as those that are long-term assets. Long-term assets are going to be like your property and equipment, your fixed assets. The plan is to hold on to those for a long time. You might have to eventually sell them, but that's when people talk about current and long-term, that's what they're referring to there. When we look at the asset section, again, cash and cash equivalent. So that's going to be your bank accounts. That's going to be your money market accounts. It might be some short-term certificates of deposits. Accounts receivable are going to be those amounts that are owed to you from other people because you're providing services. So step back. These are on the accrual basis. So the statements that we're looking at are going to be on the full accrual basis. So if your organization follows the cash basis or modified cash basis, you will not have receivables. Again, accounts receivable are payments that are going to be received in the future for services that you have provided, whether it be, like you actually sold something to someone or you provided some kind of service, maybe through your programming, training, education, that type of thing. Contributions receivable. So this is unique to nonprofit organizations. Contributions receivables occur when someone promises to give you money in the future. So if you get a grant letter from a foundation that says, congratulations, we're going to give you $100,000 next year. Because you received that notification that you were awarded that grant needs to be recorded today when you receive that notification. Even if you don't get the cash next year, the following year, when you are notified that you are going to receive that grant, that is when it gets reported. So that's what a contribution receivable is. Prepaid expenses, those are when your organization pays for things in advance. So for example, let's say you are going to have a special event next year and you have to put a down deposit on the facility. So you make that payment this year. It's not going to be used until next year. So that's considered a prepaid. A lot of times insurance is considered prepaid just because of the way the timing of the payments and the coverage period. So those are two very common prepaids that occur in nonprofits. Okay, operating lease right of use asset. This is new. You can also see under the liability section, there is an operating lease liability. So for 2022 organizations that have a December 31st year end, the new lease accounting standard went into effect this year. So what does this mean? If your organization has a lease, so you lease a copy machine, you lease the postage meter, you lease facility space, your leases are going to be recorded differently this year than in the past. So in the past, if you have an operating lease, you make your monthly payments to use the copy machine, and those go into your expense. There is no asset on the books because you are not owning the asset. The lessor owns the asset. However, the new accounting standard says that those assets now have to be reported as an asset and a corresponding liability on your books. There's a bunch of additional information that you have to look at to determine whether it's an operating lease or a financing lease, which is formerly a capital lease. We have to determine the liability over the whole entire lease. And then we have to also use a discount rate to determine the actual dollar amount that goes onto the financial statements. But what you need to know is that if your organization has leases, then you will likely see a new item on your financial statements this year representing that lease called an operating lease right of use asset and a corresponding liability, operating lease liability. So that is new this year. Beneficial interest, that's going to be like the investments in the community foundation. You could also have other types of investments or endowments that are included on your financial statements. Property and equipment, that is going to be your fixed assets. So your computers, your buildings that you own, your furniture and equipment, those types of things. Those items are capitalized and then depreciated over their useful life as opposed to expensed. So if your organization does not currently have a capitalization policy in place, that's probably something you want to consider. A capitalization policy basically says that when we purchase items that have a life in excess of 1 year and a dollar amount over whatever dollar amount, for nonprofits, common is $500 or $1,000, but again, it just depends on the nonprofit. Then we are going to capitalize those items. So we are going to put those items on our balance sheet as an asset. And then we're going to expense that asset through depreciation over the life of the asset, as opposed to expensing that full cost in the first year. So that's what fixed assets, property, and equipment are. You could have other types of assets on your books as well. These are just some common ones that we've included on the screen. So again, the assets, those are the things that you own or that people owe you for. Now, the next section is the liability section. This is where you owe other people. So just like current assets, we have current liabilities. So line of credit, accounts payable, accrued payroll, and withholdings. These are the items that are most quickly transferred to cash. We talked about the operating lease liability as well. And then if we have any loans, a note payable, that would be considered a long-term liability. So when we're looking at our liabilities, again, this is what the organization owes to other people. So line of credit, obviously, I think we all know what that is. Accounts payable, so those are maybe invoices that we've received for services that we've received or items that we've ordered and received, but we haven't paid those yet. So at some point in the future, we are going to owe that. Accrued payroll and withholdings is the amount of money that we owe to our employees for the work that they have done through December 31st. So a lot of times at year end, your payroll doesn't necessarily always fall on December 31st for work done through December 31st. So maybe payroll falls on January 5th, but that January 5th payroll is going to include work for December 2022. So that work that has been done through December 31st, 2022, but has not been paid yet is considered a liability to the organization. And that is what is included in the accrued payroll and withholdings. You might have deferred revenue. There's no deferred revenue on this statement, but that is when you are paid, you receive money for a service that you are going to be providing in the future. So you haven't actually earned it yet. So that's considered a liability. And then we have the notes payable. So those are going to be your bank loans that you've received and obviously owe at some point in the future. The last section is the net asset section. This represents basically your accumulated earnings since the beginning of time when the organization has been in existence. Net assets are divided between without donor restrictions and with donor restrictions. So without donor restrictions means this is money that the organization has received and the organization can use it for whatever they'd like. They can send their fundraising people to a fundraising conference. They can buy office supplies with it. They can buy supplies for a program with it. Whatever they want to do, you can spend your money on. Now, net assets with donor restrictions result from contributions given from donors. And the donor has said this money has to be spent on a specific program to purchase a specific item or for a specific period of time. So the donor has placed some kind of restriction on what you can spend that money on. Oftentimes you can't use this to, just buy regular office supplies. So in that instance, because it is restricted by the donor, we have to set it aside. So this balance on the statement of financial position represents the money that has been received through December 31st that has not been spent yet. So we have $267,116 of money that we have received that the donor says we have to use it for a specific purpose, but we just haven't spent it yet. We like to see, obviously, the without donor restrictions to be more than the with donor restrictions. When we're looking at this statement of financial position and all the numbers on it, there are some certain things you probably want to ask yourself to determine, okay, is this correct? What is this telling me about my organization? So the first thing is significant variances from last year. So whether you look at a year-end audited statement or your internal financial statements, hopefully you're showing two periods. So, year to date for the two different month ends or for the entire year. So that way you have something compare your current year balances to. So when we're looking at the current year compared to last year, which line items have significant variances and why? So an easy one here to see is the operating lease right of use of asset. So we have a $47,000 asset and a new $47,000 liability on our books that we didn't have that last year. So that's where, okay, there's nothing on last year's return or last year's column. Why? Well, that's an easy one because that's a new accounting standard, but that's like the type of thing you need to ask yourself. Or for example, line of credit. We have a $50,000 balance in our line of credit this year. We had a zero balance last year. Is that correct? Okay. Oh, yep. We did talk about that. We did draw on our line of credit this year because we had some cash flows issues. So that is correct. So when you're looking at your statement and you see these variances, think back, okay, is that correct? Does that sound right based on our organization's activities? Not even taking into consideration just our accounting activities, but all of our accounting or all of our activities that occurred during the year. Is that reasonable? Should we have those variances? Or maybe, wait a second, this balance is really similar to last year's balance, but I was expecting it to be more. Why is it not more? So variances is a very important question to ask. Also, we need to look at our cash balance. So obviously, we hope that that number is positive. If it's negative, that's not good. That means we've spent more cash than we have on hand. But do we have a healthy cash balance? How much cash do we have in reserves? Best practices say that you should have enough cash to cover 3 to 6 months of expenses. Not all organizations have that. Some organizations have more. I've gotten asked before if there is a limit as to how much cash or investments a nonprofit can have. The answer is no. There is no requirement that a nonprofit can only have X dollars of cash or X dollars of investments. But you have to remember that your organization is in existence to provide something, a program, what your mission is. Your organization is not in existence to be a bank or to be an investment firm. So you just want to make sure that you are not hoarding revenue or hoarding that cash and investments, that you're actually putting it back into programming. Now, there are some instances where you might have an excessive amount of cash or investments on hand because maybe you're in the middle of a capital campaign. So you're raising a bunch of funds that you're going to spend next year on a building. So there's a reason why you have those excess funds. But in general, 3 to 6 months of expenses is what your cash reserve should be, best practices. Looking at receivables, do we have a lot of old receivables? So if your accounts receivable shoots up, so for example, in this 2022, we have $48,971 of accounts receivable. Well, last year we didn't have any. So what's going on there? Maybe maybe there's a customer that's way behind in paying this year, or maybe we changed the way we do our billings, or maybe we have a new customer this year. So those are things to ask. Are we behind in collecting those receivables? Investments, what's going on in the investment world? So if our beneficial interest, our investment account balance went way up, but we know that the market is down, doesn't really make sense. So we need to be aware of what is going on in that instance to understand whether those investments and beneficial interests have been properly recorded. When we're looking at property and equipment and fixed assets, we need to consider how old those items are, because eventually we're going to have to replace those. So if we have a lot of old property and equipment, we should probably have a plan in place to get ready to start replacing those. And in order to replace property and equipment and fixed assets, that takes money. So we need to make sure that we have a plan in place as to how we're going to replace those items. Because more than likely, you probably need that equipment in order to provide your services, in order to provide your programming. So you want to make sure you have some kind of plan in place. Under liabilities, we want to look at our accounts payable balance. Same way with receivables. Are we behind in paying certain vendors? Maybe there was just a timing difference and a large invoice came in at the end of the year. That's fine. But we want to make sure that our balance isn't getting higher and higher because we are getting behind on making payments to vendors. Accrued payroll and withholdings, we want to make sure that that is comparable to last year. If that goes up, why? Because we do not want to get behind on paying our payroll taxes. The IRS does not like it when they do not get paid for their payroll taxes. So we want to make sure that we are paying those timely. So watch that balance, make sure we're paying in our payroll taxes when they should be. We talked about current assets and current liabilities. So we want to compare our cash and those current assets to our line of credit, our accounts payable. If someone said, okay, if someone came in today and said, you have to pay off your line of credit, your accounts payable, your accrued payroll and withholdings, could we do that? Do we have enough cash on hand to do that? Obviously, this organization does. They have over $400,000 of cash. They only have $120,000-ish of line of credit, accounts payable, and accrued payroll. So they are good. But if you had an organization that had a very small cash balance and a very large accounts payable balance, that's probably a red flag. And we should probably ask what's going on with that organization. And then when we're looking finally at the net asset section, again, I noted that we like to see the without donor restrictions larger than the with donor restrictions, because that means you have more money to spend on your daily operations. We also want to make sure that that without donor restrictions is not negative. If that without donor restrictions is negative, that means the organization has borrowed against its restricted money. So that means that money that has come in where the donor has said that it is for a specific purpose, those funds have actually been used to fund operations, and that's not good. We want to make sure that doesn't happen. So we want to make sure that without donor restrictions is larger than with donor restrictions, and also that it is positive. Now, when we're looking at these statements, all of these statements intertwine with the next statement. So for example, your cash and cash equivalents that are on this statement is going to flow through to your statement of cash flows. Your net assets are going to flow from your statement of activities, which we'll talk about next. So that's another thing when you're looking at your statements, especially your year-end audited statements, all of these statements are going to intertwine. All of the activity flows through from one statement to the next. Also, when you're looking at your statements, you might want to consider, hey, we have investments. Do we have an investment policy in place? When you're looking at your statement of financial position, we talked about cash and how much cash you should have on hand. So do we have a policy in place for reserves where we say, okay, we are going to put aside X months or X dollar of cash, and this is what we're going to use it for, etc. Investments. If we have investments, are there certain things that we can or cannot invest in? Some organizations don't want to invest in a certain type of stock because it's more risky, or maybe they don't want to invest in a certain kind of stock with a certain company because they don't agree with that company's values. What are the goals for the investments? Is it long-term? Is it short-term? So those type of things. Similarly with an endowment. If you have an endowment, or if you're thinking about having an endowment, make sure you have an endowment policy in place. This is going to note what the purpose of the endowment is, again, what the funds are going to be invested in, and then also the spending policy. So how much of that investment endowment balance can be withdrawn each year. We talked about the capitalization policy. So again, that's when you're taking those items that have a life of longer than 1 year over a certain dollar amount, and we're capitalizing those and depreciating those as opposed to expensing those. Along with fixed assets, having an asset replacement plan. So identifying those current assets, determining when they need to be replaced and how we're going to replace them. Are we going to have to go get a grant? Are we going to have to go get a loan? Are we going to fund it ourselves? And then finally, board designated. We didn't talk very much about this. We did talk about donor restricted. So only a donor can restrict contributions or funds. Board or management can designate funds. So the difference is that when unrestricted money comes in, funds that are without donor restrictions, hey, I like your organization, here's $20,000, you can use it for whatever you want to. If the board wants to set some of that money aside for a specific purpose, they can. So this happens a lot when we're getting into a capital campaign. The board may say, okay, we are going to, we're going to have a capital campaign. We're going to go ask people to donate to the capital campaign. But before we get started, we are going to show that we're going to support this as well. And we are going to designate some of our net assets, our cash without donor restrictions, and we are going to set it aside over here for this capital campaign. With board designated funds, the board needs to vote on it and then, note that in the minutes what it's been designated for. But if for some reason they wanted to undesignate it, you can certainly do that by, again, doing a vote. But again, board designated is different than donor restricted. The board cannot designate donor restricted money, but they can designate money coming in that does not have any type of restriction on it. So if your organization wants to do that kind of thing, you do not have to. But if you do, you probably should have a policy in place. And then also note that in the minutes when that happens. And as we talk about these different policies, if your organization doesn't have one of these policies in place or would like to see a sample or compare a sample to what you have, please reach out to us. We have a lot of these sample policies that we would be happy to provide to you. Okay, next is the statement of activities. So this is going to be your income statement, and you can see that there are some requirements that need to be met for the statement of activities as well. But basically, this is your revenues less expenses, which is going to equal your net income. All right, so this is the statement of activities. Unlike the balance sheet or the statement of financial position where it was for just 1 day, so that was as of December 31st, this is for a specific period of time. So this one is going to be for the year ended December 31st, 2022 and December 31st, 2021. So as you can see, each year has 3 columns. When you look at different statement of activities, it may look a little different than this way. This one, there are different ways to do it. I think this is probably the most common setup. So the first column without donor restrictions. So again, this is money that has been received that can be used for whatever you want. And then the expenses are spent. The second column is with donor restrictions. So this is the column, it's really a timing difference. So this is money that has been received by the organization for a specific purpose. So as you can see, they received $190,000 of contributions during 2022, where the donor said, okay, you have to use it for a specific purpose. Net assets released from restrictions of $181,226. They spent $181,000 of restricted money during the year. Now, that could be from the $190,000 that they got, but it could also be from balances in the prior year. So as you can see, if we look down further in that column where we have net assets beginning of the year of $260,000. So at the beginning of the year, we had $260,000 of unspent money that the donor had said, you have to use it for a specific purpose. We didn't use that as of December 31st, 2021. So that got rolled forward to 2022. In 2022, we also added $190,000, and then we spent $181,000 to come down to the very bottom of $267,000 that we have left that we haven't spent yet. And then we also have a column, the 2022 total, that shows the total of all of the funds during the year. The top of this schedule shows your revenues. Nonprofits get all different kinds of revenues. Some organizations rely completely on contributions. Some have program service fees. Some have rent income. So it varies. Organizations that have a lot of different types of revenue sources are probably a little bit more set to be sustainable because they have those different revenue sources coming in. When you're looking at your statement of activities and you see limited or only a small amount of revenue sources, it could raise some concern. The risk there is if that revenue source goes away, or if that donor goes away, will the organization be able to survive? And it might, but that's just a question to ask. So we have contributions. Obviously, that's when someone gives you a donation, they don't expect anything in return. Contributed non-financial assets, that is in-kind contributions. So again, that is a new standard that went into effect. So it went into effect for the June 30, 2022 year ends. So you December 31st, 2022 year ends will also see this this year. It's called contributed non-financial assets. That should be on a separate line than your regular contributions. Government grants, some organizations will receive grants from the government. So usually you want to separate those out so you can distinguish those from the other types of grants that you get. Special events, the proceeds are going to be the amounts that people pay to come, like if to buy a ticket or whatever the fee to play golf is. And then the direct benefit to donors is going to be what they receive in return. So whether it's the food, the ability to play golf, that type of thing. Program service fees, that is going to be when your organization does some kind of service, provides something and pays in return. Sorry about that. Other income, sometimes there's just miscellaneous other income that you receive. And then your interest income, gains and loss on investments, that's also considered revenue. Nonprofits are required. Also wanted to mention this line here. So this net assets released from restrictions. You can see that in both 2022 and 2021, there are two amounts and they offset each other. They net to zero. This is just a reclass. What this is doing is you have two columns without donor restrictions and with donor restrictions. So you have two pockets. That's really what it's doing. It's just putting the money from one pocket to the other. So it's not 101.81.226 coming in or going out from somewhere. It's just we're moving it from one pocket to the other. That's what that is doing. So when you see net assets reclassed from restrictions, that's what that line means. So then we come down to our expenses and losses. Nonprofits are required to allocate expenses between program, management, general, and fundraising. So that's why we have those three lines. And then we have our losses. And then our change in net assets for both 2022 and 2021, that's basically going to be your net income. So again, what to ask when we're looking at this statement? Again, we want to make sure we understand what period is being covered. Is it the whole entire year? Is it just a month? We need to understand that in order to make sure that the numbers look reasonable. Just like on the statement of financial position, we want to look at variances this year compared to last year. Where are there variances? Why are there variances? For example, this one you can see special events in 2022, but there were no special events in 2021. Well, that's because in 2021, there was the pandemic and we were not able to hold an event. So easy answer, makes sense. Also, you do have some flexibility as to what you report on these statements. For example, contributions, government grants, you want to separate those out so the reader clearly understands the different types of revenue that you get. But for example, you get a lot of foundation contributions, but then you also get a lot of corporate contributions, and your reader wants to see that. So maybe you say, you add a different line, you set those contributions apart into foundations and corporate contributions. You can certainly do that if you'd like. So when you're looking at the statement for your organization, just make sure that the correct level of information is provided for the reader. Again, how diversified are your funding streams? One thing to look at too is, if we have a large amount of with donor restricted funds, make sure you understand what that money is supposed to be spent on and ensuring that that money can actually be spent. If we receive $200,000 in a prior year for a program that we're no longer doing, that's an issue because we're not going to be able to spend that money. So we're going to have to go back and talk to the donor and ask them if we can spend it for something different. So just making sure you're understanding when you do have that money with donor restrictions, that you understand what it's supposed to be spent for. And again, these statements, they tie to the other statements. Your net assets at the end of the year, they flow into that statement of financial position that we just looked at. And your expenses are going to flow into the statement of functional expense that we'll look at next. For the statement of activities, there are some related policies that you might want to consider looking at. The first is the gift acceptance policy. So when we're accepting contributions and non-financial gifts from different donors, are there certain gifts that we will not accept? For example, if your organization has never owned a building before and someone asks you if you would like a building, will you accept it? Or for example, will you accept Bitcoin? So putting that in writing so everyone knows, your staff, your donors, what your organization will and will not accept. Contribution substantiation really isn't a policy per se, but what is the process that your organization has for thanking donors? Donors can only deduct on their tax return donations that they have substantiation support for. There's specific items that have to be included in that support. So making sure that your organization is providing that to your donors. And then finally, expense allocation. How do we allocate expenses? And we're going to talk about that more in just a minute here in the next statement of functional expenses. So the statement of functional expenses really provides some additional information on the expenses of the statement of activities that we just looked at. So again, it is for a specific period of time. When you're looking at your audited statements, the statement of functional expenses can be in an actual statement or can be in a footnote. A lot of times it is in a separate statement. So this is a statement of functional expenses. Just like the statement of activities, it is for a specific period of time as opposed to just one date. So it is for the total year ended. So again, we have multiple columns for each year. So for 2022, again, all nonprofits have to allocate expenses between at least 3 functions: program, management in general, and fundraising. If you have more than one significant program, you might have multiple programs listed here. This organization primarily just has one program, so they've put all their program expenses together. Program expenses are those expenses that are related to offering that program, your mission, what you are in existence to do, salaries, supplies for the program. Maybe if you have those building related costs that relate to the specific portion of the building that is being used for that program. Management and general expenses are those just general business expenses that you have to have. So for example, your audit cost is a management and general expense. Doesn't matter what kind of programming you are offering, because you have a business, because you have a nonprofit and have to have an audit done, you have to have an audit done. That's just the management and general expense. Fundraising expenses are those expenses that relate to trying to get people to give to your organization. So if you have like an annual mailing request, your special event, you know, the supplies, postage related to that, those types of things are fundraising expenses. When you're looking at and again, when you look at the statement of functional expenses, the total expenses on the bottom line here, they are going to tie back to that statement of activities that we just saw. So this is really providing additional information on your expenses, where your funds are being used. You can have different accounts down the left. That's fine. You want to make sure though that your reader of the financial statements has enough information to really understand the different types of expenses that your organization has. Obviously, you're not going to put your salary expenses and your travel expenses together. Those are two different types of expenses. But you can break it out however you would like, where you think the reader of the financial statement is going to have the best understanding of your organization. When we do it, DWD does the audit, we usually like to put salaries at the top because that's your largest expense, your people. And then we try and kind of categorize the expenses to a relatively high level, but also give enough information so the reader can see the different types of expenses that an organization has. When you're looking at this on your organization statement, you obviously, again, want to know what period of time is being compared, because if you're only looking at a month versus a year, you're going to have different expectations. Again, you want to look at variances. Why did salaries increase so much from last year? Well, we hired 2 new people. Great, makes sense. But if there's other reasons, other variances that just don't make sense, we want to make sure that we understand why and if that really is correct. Talked a little bit about the categories. Are they reasonable for what our reader's needs are? And then allocation. So I mentioned having an allocation policy in place. When we're looking at this statement, we need to see whether these expenses are being allocated in a reasonable manner. So obviously salaries, that should probably be allocated based on the time each person spends in the different areas: program management in general and fundraising. I mentioned like legal and accounting, that's normally allocated to management in general. But then we have some expenses like telephone, postage, supplies, depreciation, utilities. Those kind of cross over to all of the different functions. So how are we allocating it? Are we allocating it based on square footage? Are we allocating it based on full-time equivalency? So understanding how we are allocating those expenses and making sure that it is in a reasonable manner. Obviously, if we have contributions, we need to make sure that we have some fundraising expenses, because someone or some expenses are going into gaining those contributions. So we really should make sure we do have some kind of fundraising expenses. When you're looking at your statement of functional expense as well, you want to also determine not only if the basis of allocating those expenses is reasonable, but then just looking in total what those allocations are. So for example, on this nonprofit, they have 75% allocated total expenses allocated to program, 11% management in general, and 14% fundraising. In 2021, they had 84, 11, and 5. So you want, obviously, the donors want most of their money to go towards programming. There are different watchdog groups out there that look to see how much is being allocated to program. Better Business Bureau, United Way, those type of Charity Watch, they like to see, 75, 65, 75, 80% allocated to program. But you also have to remember what your organization does. So you can't necessarily, that's kind of like best practices, but your organization might be different. You might have all volunteers that do all your fundraising. So maybe you don't really have any fundraising expenses, or you might be going through a huge capital campaign this year. So your fundraising expense is going to be, percentage is going to be really high. So you do have to make sure that you take those different nuances into consideration. But in general, 70 to 80% should probably be spent on program. Now, you don't want to just go through and say, okay, every line it's 75% we're putting to program. That's not how it should work. You want to make sure that you have a reasonable basis in mind and allocation process to allocate the expenses across all of these 3 functions. And again, these different The numbers on here flow through to the other financial statements, to the statement of activities that we've talked about as well. The final statement is a statement of cash flows. I am not going to go into this one very much. I just want you to be aware that if you have audited or reviewed financial statements, you will probably see this statement of cash flows. If you have an internal financial statement, you probably will not have the statement of cash flows unless your accounting department is very advanced. This is what it looks like. It is for a specific period of time. It divides your activities into cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. You want to make sure your cash flows from operating activities is positive. Sometimes it's negative. That's okay. It happens. But in the best circumstance, you want your cash flows from operating to be positive. So again, not going to go into this statement very much just because it is a very kind of hard to understand statement, but wanted you to be aware that there was an additional statement for that. All right, so that is kind of all of the statements themselves. This is just a summary of when you're looking at your financial statements, what to look for. I think we've kind of talked about a lot of these already. Variances, do you have unexpected variances, or maybe there's variances when there shouldn't be? Negative cash, what is going on within your organization that's going to be reflected in those numbers. And if something happened during the year and you don't see that reflected in the numbers, you should probably ask why. Also, when you're looking at your financial statements, there are different ratios that you can use. Obviously, you don't just want to go Google all the ratios and apply them to your organization. Not even all these ratios on this slide are probably going to be applicable to every nonprofit that's listening in today. But the ratios do help you in kind of determining where your organization is in comparison to where it has been to other organizations. So I have provided some of those on this slide if you'd like to kind of evaluate where your organization is at with the different ratios. Remember, your financial statements tell your organization stories in numbers. So when you're looking at them, make sure that they are telling the correct story, because as we said, your financial statements are going to be viewed by a lot of different people for a lot of different reasons. And you want to make sure that the story that they are telling is the correct story. Tyson, do you want to wrap us up?
Sure. I just want to remind everyone that this webinar was recorded. Slides and video are going to be available on our website in the not-for-profit section. A link to that section is going to be emailed out to everyone attending today, along with Carrie's slides. While you're on our website, make sure to sign up for next month's webinar. It's going to be on May 11th. We're going to cover new Allen County not-for-profit changes. Remember, our webinars are open to everyone. Feel free to share those links with other people within your organization or maybe board members. And I want to thank everyone for joining this morning, and have a great rest of your day.